My name is Will Amira. I'm the Connecticut field agent with Land for Good and a vegetable farmer in Morris, Connecticut. And I'll be here today to kind of help facilitate the meeting, keep an eye on the chat for questions, and make sure all of the tech goes smoothly. So if you need anything, feel free to jump into the chat and let me know. So to give us a sense of who's in the room today, it looks like just over 50% of the folks attending are senior generation or older farmers, 15% junior or next generation farmers, 15% farm service providers, and 15% others. A little more than half of the folks on the call have an accountant identified. That's a great start. Hopefully we'll hear a little bit more about what to look for and how to feel confident in that decision and know what you're looking for today. And a very decisive crowd. A little less than half feel like they have adequately prepared for retirement. A little more than half say they have not, and not one heck if I know. I think that's an improvement from last year. So great. And if you are here today for the third session of the Farm Succession Planning webinar series, you're in the right place. Today, we're going to be covering financial retirement and tax considerations, including taxes, farm viability, and retirement in that as well. Pictured on this first slide is a farmer from Connecticut, Chris Hopkins, who worked with us on a transfer of his own in his small value-added dairy business. Let's see. We'd like to thank the funders that have made this series possible. Funding coming from the Vermont Housing Conservation Board, the Connecticut Department of Agriculture, as well as the USDA National Institute of Food and Agriculture. And we also would like to thank our sponsors, Nick Bullock, who will be presenting today from Farm Credit East, as well as Daphne Moritz from Sheehy, Furlong, and Bem, who presented last week. Thank you so much for making this event possible. Well, we got a few more folks in the waiting room I'm going to let in, and I will stop sharing my screen. Mike, feel free to take it away.
Good morning, everybody. Welcome to the third session in our program. I want to remind everyone to please stay on mute during the presentation. A little technical difficulty. We're gonna this is the third session. Next week will be our final session, which will be a farmer panel, and that's always one of my favorite sessions in this. And I really want to encourage you to participate in that. We do always like to get questions during our presentations, but during that one, it would be great to also have people who might be willing to share some of their own experience. All right, I don't know why this is being difficult today. It wasn't earlier when we tested. All right, here we go. That. So for the first part of this, for about a half an hour or so, 40 minutes, I'm going to be presenting on retirement planning, a little bit more on healthcare, different than what we talked about last week. And then we'll have a little time for Q&A. And then Nick Bullock from Farm Credit East will be presenting for the remaining part of the session on taxes in farm transfers. The mantra that I've kind of adopted over the last several years after working for 17 years with people on farm transfer planning is that really this part on retirement is definitely something that can't just be about farm transfer planning. By the time we get to someone in their 60s or 70s, and if they're thinking about retirement, and there's a lot of things that you can't do that you can start doing when you're in your 20s or 30s or 40s, towards preparing. And so I'm hoping that the 15% that was in the room that's of the younger generation will really pay attention to this and not tune this part of it out. And also that, the older generation here takes home to the younger generation in your life who may not be on here today to really be thinking about retirement planning at a younger age. And as much as possible, I'm trying to integrate the retirement planning in with the business planning that I do with young farmers, including farmers that are just getting started. What can happen if there is no plan and there's no savings? A lot of times, there's a lot of farmers when they're younger, they're definitely not thinking about retirement at all. And many farmers will often think, I'm never going to retire. I'm going to die on the tractor and it's not going to happen. And then unfortunately, people get to the point later in life where they realize maybe I do want to retire or I need to retire for some physical reason. And then at that point, they find themselves unprepared financially or otherwise, very often because they've listened to their either on their own or sometimes I've seen with some very vigorous tax accountants, they've made profit go away, and as a result, there's no on the tax forms, and there's no self-employment tax being paid or very little, and the farmer ends up with meager Social Security. And I've worked actually with a couple of farmers who actually managed to totally not pay into the system and ended up finding themselves not eligible for Social Security or Medicare, which is actually kind of a difficult thing to do, at least legally. And that caused some real problems for them when they had healthcare issues. And with little or no outside savings, in addition to Social Security, then the sale of the farm assets become really essential to the retirement, and that can make things difficult for the transfer in a way that's affordable to the next generation. If there's a lot of debt, as people are getting close to retirement, even the sale of farm assets may not be enough to fund a robust retirement, particularly after they've paid capital gains tax. On the opposite side is I've worked with several farmers who have saved for retirement. It is possible. People do it. And they've also maybe not shorted themselves on Social Security. And so it's allowed for a lot greater flexibility into how and when they retired. Higher Social Security is definitely only a part of the retirement piece, but having a sufficient Social Security has meant that there's been less reliance on some of the other retirement savings, or the need to maximize returns on farm assets. There's a greater flexibility in how they transfer the farm, longer horizons, greater use of gifting, ability to give bargain sales, not an immediate need to sell the real estate, so they can allow the younger farmer to build up equity in a business while they're renting the farm. When I sit down with farmers, really at any age, but particularly as they're getting towards closer to what would be a typical retirement age, first thing I ask people is, do you plan to retire? And, as I stated, a lot of them will tell me, no, they don't expect to. Not everybody gives that answer. And more I'm finding people that do have definitive answers. And that's becomes part of their target on the farm transfer, or at least parts of the transfer, about when they want to step out and when they really do want to retire. And even when people think that they don't want to retire or they want to push out the retirement further, I think it's important for people to have a contingency to think about, well, what if there is some sort of health issue that comes up, or some sort of change in circumstance that makes you change your mind about that. And then I'll ask people, well, what does retirement mean to you? Because that means so many things for so many different people. The phrase that I have gotten from dairy farmers over the years more than once, and it's kind of subliminally in the culture, I guess, I've heard more than one farmer has said to me, well, when I get to 65 or 67 or whatever it is, I don't really want to retire, but I just don't want to be in charge of a herd of cows anymore. And I've had vegetable farmers and orchardists and so forth say something very similar. I don't want to stop working. They just don't want to be in charge. They don't, at least in theory, in their minds, they don't want to be decision makers. We'll talk a little bit about how that or be sometimes not a reality for them. We've already mentioned that some where people have had difficulty giving up control, but for many people, they just don't want that stress of having manage the money and manage the business. And for others, they really don't want to step back. So trying to sort through that kind of personal part of it is a really really big part that often gets overlooked because we get so focused on the money. Thinking about um, the retirement maybe is not as a date, though you might have a start date. Thinking about it as a process of maybe stepping back, pulling back, giving more responsibilities to younger generation, looking at that as a positive thing towards helping them start to gain management experience and control while you're still a part of the business, so that they start to really be able to, there's a real succession plan. And so thinking about as you age, how you might just want to transition and what tasks, what jobs still reward you on the farm that you want to take over, or keep taking on, even after you have maybe completely turned over in business and don't own anything, but still maybe want to be a part of, or maybe you want to do a second career. Maybe there's other jobs, other things that you want to do, things that you've wanted to, types of businesses or types of jobs that you just, you've been farming and you just never took those on, but there were things that you thought might be interesting to you or fun that's outside of the farm. And then of course, there's the people who classically say the classic retirement of I want to go travel, I want to go see my grandchildren that are across the country. Um, so after we've kind of worked through that, we start thinking about the financial part. And so the first thing that I start working with people is to think about how much do they need annually. And one of the biggest challenges, whether I'm working with younger farmers who are just starting their business and trying to think about what do we need for the farm to be generating so that we're actually making a living that feels like a good quality of life for us. And then certainly for these farmers that are now thinking about transferring the farm and transitioning out, is they don't know necessarily what their cost of living is. Any generation, that's a problem outside of the farming industry, but I've definitely seen it to be a big challenge within the farming industry that even some of the best farmers I've worked with who have really good financial records for the business have no idea what their cost of living is. And particularly as people are getting older and thinking about stepping out, you have to think about how things are going to change and also what the farm is covering now and what the farm may not cover going forward. I don't um, I don't I tell people I'm not the IRS. I am not a tax accountant. And if you're expensing all the propane that gets used for the greenhouse that also supplies your hot water in the house, I'm not gonna be the one to come down on you, but I am gonna point out that if you're leaving the farm, you may have a propane bill for hot water in your house that you didn't have before because you treated it as a farm expense. All of your heat comes from firewood on the farm. Are you going to still be able to do that? Are you still going to be in that house? Are you still going to be in a house that has wood heat, or is that going to change? You're going to have a heating cost, and so starting to think about what those changes might look like. And going along like that is one of the big challenges that often come up in farms that don't have multiple houses on it, where people want to stay in the farmhouse is there housing for both generations on the farm, or is there going to be a need for construction? Of course, construction costs are very high. Or just if you're going to stay in your house, a very basic question that people really need to think about as they age is, can you age in place in the house? I was just at a farm last week, and one of the farmers got up in the middle of our meeting and went down to the basement to put wood in the wood furnace. And that stimulated discussion I was going to have with him anyway about the fact that as you age, going downstairs to a basement is a big source of falls, and not everybody can do that. So can you still be in this house with that kind of heating system, or do you need to do something different? How many steps does it take you to get in and out? You live on the first floor. These are things we don't like to think about, but I've seen them come up as issues over time where people are not prepared for the inevitable aspect of aging and thinking about, is this a home that I really can stay in? What can I do to maybe modify it, prepare for that, to think about a different heating system where I don't have to go downstairs? Or like when my father was in a wheelchair the last 2 years of his life, we widened some doorways, we put in some ramps, we took out the shower and put in a shower that was a walk-in with a bar so he could transfer, and a seat so he could transfer from his wheelchair to the shower. Are those things that you can do that? Is it realistic in the farmhouse that you're at? And people really need to be realistic about their healthcare needs. And a lot of those are unpredictable, but some of them you can see coming, especially if you've looked at what's happened with your parents and your grandparents and other people around you. I just ask people to be realistic, because the thought that I'm healthy now, I'm in good shape, farming keeps me in good shape, which it often does. And I know farmers who have basically died on the tractor. That's not everybody. When we talk about the cost needs, we talk, there's this concept of the retirement smile, which is basically that, and when you look at this chart, don't necessarily pay attention to the ages. That's not really the important part of it, but just think of the bottom part of the line as over time. When you retire, your income needs are going to be about what they were before you retire. Used to say that you might need about 80% of your retirement needs, but nobody says that anymore. Everybody realizes that most people need at least as what they were using before retirement. And with some farmers I've worked with, they need more afterwards because they never traveled while they were farming. And now they're like, this is just, this is finally our time. I just was talking to a farmer yesterday at the Vermont Vegetable and Berry Conference who I've been working with, and he was telling me about how, since he's transferred his farm to a younger farmer, that he and his wife last fall went with a friend to Switzerland and to France. They would never have done that in the fall prior. They were definitely, made a bigger trip than they would have otherwise. I've sat in more than one kitchen where people have said, "Oh, you promised me when we retire, we're going to renovate the kitchen finally. We're gonna put some money back into the house." And so some of these things keep those expenses up. As you get further into your elder years, very often you stop putting money back in the house. You don't buy another car. You stop traveling. And so your expenses may go down. Towards the end, for many people, expenses go back up. The other side of the stile is unfortunately the long-term health care. One other thing that you need to factor in is on the income side is inflation. I've been doing this presentation for several years now where inflation was 2% or less. And I'm part of the people that the reason I was using 3% inflation at that time, I haven't changed the slide in all these years, is because that's historically the average inflation. And unfortunately, the last couple of years is tipped on that other side of the average. So we went from having 1 foot in ice water to having the other foot in boiling water, and on average, maybe I think we're still at 3%. But inflation over time means your cost of living, if you figured it out now at $40,000 a year, in 10 years, if we keep up with 3%, which is the historic average, even though the Federal Reserve is trying to get us down to 2%, 3% is about where we are now. In 10 years, you'd need 51,000 to cover those same living expenses. And in 20 years, you need 68,000. And so factoring that into, looking at the funds that you have available is important. Because you don't want to take a step backwards as you get older. But these are the sources that we will typically see for farmer retirement. It's a real collection of funds. And so once we've gone through that, an exercise of trying to figure out the uses, what is the true cost of living for someone now, when you take out anything that the farm's covering, start looking at the sources. And we'll go through a number of these, over the next 15 minutes or so. But it's usually a collection of most, if not all, of these types of income stream. Social Security again, I want young farmers to pay attention to this because it's based on your top 35 years of earning. So not really, so of course, I want older farmers here to pay attention to this too, but you have to keep in mind that it's looking at an average over many years. And so how you're reporting your income on your Schedule F, and then what many people don't understand is that when you take that bottom line from your Schedule F, you go next to your SC form or your self-employment tax form, and that's where you pay the employer and the employee side of Social Security. And that's what's going to dictate what you're going to be eligible for later. And I've seen big disparities in farms in terms of what farmers are able to collect. And I've seen larger farms with a lot more income. The farmers are collecting less Social Security than farms that were much smaller, maybe not quite as profitable because of how reported their income for decades on their self-employment. Sometimes spouses are hurt because it's a sole proprietorship and the spouse is not listed as a partner or employee, or there's what's called a qualified joint venture. And for the last slide, or the previous couple slides ago, where we talked about inflation, one thing that's different about Social Security than most other retirement sources is that Social Security payments are adjusted for inflation. And we saw that the last 2 years where it was the highest cost of living adjustment, or COLA, that we had seen in like 20 or 30 years. And in many cases, other people's retirements were not necessarily going in that direction. One of the things that I tell people too is that when you get to the end of the year and you're thinking about, oh, if we have a good year, a good profitable year, a lot of farmers are thinking about how do we make that income go away? And if it's the right time to make certain capital investments and you would be doing so for a business reason that's going to improve profitability, I'm all for it. If you're going to do it just to avoid taxes, I think it's a mistake. If you want, I would say I'd rather show the profit, pay the self-employment tax, and then if you want to reduce your income taxes, think about using IRAs as a tool to be able to reduce your income so that you can reduce your income tax. So at least then that you're reducing your income tax, and then you're saving some money for your retirement years. And everybody that's ever heard anything about retirement knows that you have to take the benefit of saving is that over time, a little bit of money aside each month or each year can grow to a lot. And if you wait to the last minute, there's a lot less opportunities to change that. We want people to start early and take advantage of the counting. I encourage people to contribute as much as they can, even if it's just a small amount. I think there's a lot of push out there to say you should be doing this percentage of your income and so forth. That's just not always possible, especially with a farm where your income sways quite a lot. So to think about putting your money, even a small amount of money, and you can contribute to your IRAs now for 23 up until the time that you file for your taxes, or April 15th. So you can look back and say, how did I do last year? Can I actually put more into my retirement this year or not? When you're putting it into retirement funds, if you're going to work with a financial planner, make sure they're what's called a fiduciary. It's very important. That means they're looking out for their financial interest, or for you, excuse me. Fiduciary is working out for your financial interest and not their own in terms of fees and so forth. They're working on your behalf. And so ask them directly, are you a fiduciary? And watch out for the fees, because a lot of retirement funds that are managed and have high fees that'll cut back into what you're going to have available for yourself. A lot of farmers I work with they're cautious about putting their retirement funds into investments because they don't want to support certain types of businesses, but there are socially responsible advancement funds, socially responsible funds that are available. And so people should consider that. Of course, right now, it's possible in many cases, to put retirement funds in CDs and money markets that are actually earning decent interest for the first time in several years. Now, we don't know how long that's going to carry, and it's still not going to earn as much as stocks, but it's still another option when you don't feel secure about investing money. I also encourage farmers to really look out for watch their asset allocations, because I've worked with farmers who started putting money aside maybe in their 30s or 40s, and it was based on a mix of stocks and bonds, or nowadays it could be money markets and so forth, for their age when they were younger. Now they're getting closer to retirement where you want to have less risk. And so, but they haven't been paying attention, so they haven't moved their funds out of out of more risky stocks into less risky investments. When I'm doing budgeting with people, I start with, and this is a very crude way of doing it, but starting with what's called the 4% rule, which is to look at what are the retirement, the total value of the retirement funds that you have. And then you can take out safely 4% a year without outliving your expenses, or outliving your retirement funds, excuse me. And the important thing to know about that is that 4% rule came from the idea that we were looking at 3% inflation, and that we were also looking at a return of at least 6%. If your funds aren't in anything that's returning 6%, or inflation is over 3%, 4% rule kind of falls apart. And that's where working with a financial advisor during your retirement years can help make some adjustments. But that's kind of a crude, basic way of knowing what you're going to have available in your retirement funds. Because you can look and say, I got a couple $100,000 in savings, and that sounds like a lot. But one thing I'd point out to people too is, if you retired at 65 and thought you might live to 90, and that's 25 years. So if you had $100,000, you took 4%. Well, you took 4% based on the original amount, which would be $4,000. And you kept that consistent, two things would happen. By the time you're 90, 100,000 is gone. You've only been taking 4,000 out of the year. Inflation has been eating away at what that buys for you. So when it comes to selling assets and conservation easements, this is where Nick starts to come in. Really important to understand the tax implications as you're setting up different transfer strategies. Understand what you might be liable for taxes, particularly capital gains tax, and that's what Nick's going to get into more. Easement sales are taxable events, so if you're going to sell a conservation easement, you have to keep that in mind. And what I've come across is that many accountants, what they will do, I'm not going to get into the weeds too much here, but we can later if people wanted to, but they will take what's called your tax basis on your real estate. If the tax basis is greater than the easement value, it will just reduce the tax basis by the amount of the easement. Or even if it's not, they may reduce it to zero, and then you might have a little bit of tax. And where I've seen, and so that's great, you don't have to pay tax at that point. But what I see is people 10 or 20 years later, they go to sell the farm, they didn't remember, or maybe they weren't told, I don't know, but they certainly seem unaware that their tax basis is low as it is, or even zero, and that a good part of the farm is going to be subject to capital gains tax as a result, because that easement sale they did 10 or 20 years ago. As I keep saying, debt has to be figured in when you're selling assets. Are you actually going to net something that's actually going to cover your retirement in your sale? Installment sales are frequently used and can be beneficial to both generations, but it's not without risk. You need to know the parties that you're working with. You still need, even if it's family or people that you've worked with for a long time, you still need to do your due diligence, work with an attorney, look and say, is the financing, can I approve of financing in a way that I'm comfortable that this person's actually going to be able to make the payments to me? We're not going to be talking about default, foreclosure. But in those installment sales deals, you can get some tax benefits in many cases. You might be able to reduce the price and make it back in the interest that you're charging. I also point out that person-to-person sales, you do need to charge interest. The IRS does require that as the applicable was it AFR? I always that stands for AFR rate, and so you can't just do an interest-free installment sale. And big bold there, easement sales can only fund one generation's retirement. And we've seen a lot of people use easement sales to either fund retirement or address non-farmer heirs, that's you can't do that again, because most of the easements that we're dealing with, particularly here in New England, are permanent sales of easements for perpetuity. And so I've come across farms where they've multiple farms at least, where the conservation easements were sold 30 years ago, and that funded the previous generation's retirement. But then this generation that bought in didn't save for themselves. Now they can't go back and sell development rights again and do the same thing that was done to allow them to buy the farm more affordably. So we can keep using the easement sales for that purpose. Then that next generation that's buying in really has to think about the fact that that tool is not going to be available to them. So I just want to do a couple of slides on healthcare. We talked a lot with Daphne about Medicaid and the legal planning, but I just want to emphasize a couple of points and also talk about a few other issues around healthcare that we didn't cover. If I get to put it, and I'll put it in the chat later, but Vermont Public Radio on this date that's on the slide here had a good Medicare explainer. There was also a lot of policy discussion in there, but it explained a lot about Medicare and the different parts, because that confuses people. It's not just one program per se. I mean, it is, but there's many different things that you have to decide when you sign up for Medicare, and that can confuse people. And there were some good explanations in that VPR program. Everybody needs to sign up at 65. This is important. I've come across a couple of farmers, and actually one I'm working with now, who said, well, I'm not going to retire at 65. So I don't know if they ignored the letters that came or whatever, but they didn't sign up for Medicare at 65 because they figure, oh, I already have health insurance and I'm not going to do it. But that you get penalized if you don't sign up within a certain amount of time of your 65th birthday. So you need to do that because you don't want to incur those penalties. Medicare will not always cover 100% of your cost. It's very, very good insurance, but you do still have to budget for other out-of-pocket expenses, and that can be a challenge. Some people are dual eligible for Medicare and Medicaid. And as Daphne was talking about last week, Medicare is for acute short-term care, not long-term care. And you really do have to keep that in mind. And I'd say one of the planning for retirement, budgeting for retirement, one of the biggest challenges for me, and I go to a bunch of trainings and pick people's brains, but I still don't see anybody's got a great answer here in the US for how do we budget for healthcare in retirement. We don't have a consistent system that covers everybody for everything that they need. People are coming at it from different income brackets. And also, we, of course, don't know what individuals' healthcare needs will be. Will they be like my father, who spent the last 2 years in a wheelchair when he died at 80, and had several health issues from the time he was 76 to 80? Or will he be like a friend of ours who was 76, same age as my father, and when they were both 76 and my father was going to the hospital for emergency surgery, Ryan was on the hockey rink, playing an adult hockey league, took a shot on goal, had a heart attack, and died as his wife agreed he would have wanted to go. Just dropped there, and there was no long-term care for him. Went a lot younger than he should have. There was no long-term care, and we couldn't possibly have budgeted for that. And it's hard to know, but sometimes if there's, I've worked with farmers that are developing on Parkinson's disease, people that have started with dementia. So there are, sometimes you do know that there are things that are kind of guiding you towards where you might have to consider healthcare differently than somebody who feels like they're in tip-top shape and that they're on their way to really having some good health in their later years. Long-term care, as we talked a lot about, is very expensive. It's beyond the reach of most people. I think last week was using $8,000 a month. I've seen, particularly for memory care, it can be $15,000, $16,000 a month. And that's why working with someone like Daphne on the long-term care planning is the big issue that comes up frequently in the planning work that we do. The thing that sometimes farmers will say to me now, that especially the estate tax, the federal estate tax is not a big deal, where we used to get people who are concerned about that kind of estate tax planning much more. Now it's more about, I don't want the nursing home to get the farm. The nursing home doesn't want your farm. They just want to get paid. And that's the problem when you don't have long-term healthcare insurance, which has proven to be really inconsistent, very costly. It's hard to actually recommend to people to pursue it because it's not been as effective tool, particularly as people live much older ages and inflation starts to catch up on the cost of healthcare. And so many people are, as we talked about last week, trying to make themselves Medicaid eligible. As we emphasized a lot last week, and it's worth just saying again, you have to pay attention to the 5-year look back period if you're trying to gift assets away so that you don't have them on your books to be eligible for Medicaid for the long-term health care. Do that within 5 years of going into a nursing home, they will claw back that they will want to claw back what you've gifted away. So again, work with an elder care attorney. So what's some of the alternatives? This is where when I sit down with people, and particularly as we're getting closer to that period, or where there's maybe very clear that this may happen, or even if it's further out and more abstract at this point, because we don't know what there will be healthcare needs. Talk a lot about what the role that family can play, whether they're on the farm or live in the area, and even I've had some non-family successors who've taken over a farm, and part of their agreement, which has been a gentleman and a gentlewoman's agreement, is that they will help provide long-term care if needed. But you always have to keep in mind that the younger generation is also maybe have young children to take care of. They have a farm business to take care of, and it may be very difficult for them to put as much time as they would want to take care of their parent. I have seen this done successfully, especially if there are a kind of a tag team between different family members. One farm family that I worked with, I was working with transferring the farm to their 30-year-old daughter. Well, the mother in that family was commuting back about an hour's drive 3 days a week to live with her parents to relieve her brother and I think another sibling. And so 2.5 days a week she was there providing care, and then she came back to the farm. And part of the way that it was possible was because the younger generation was coming into the farm, and so they weren't involved with taking care of the grandparents, but it allowed the mother to be able to go back even an hour away for that. As I said, the long-term care insurance is expensive. It's a little bit better price if you're younger when you can get it at the minimum age, which I think is 55, but it's not, it's not the answer otherwise. A lot of times too, there's a compromise with or an effort to say we're going to set up the house so that they can be there and age in place and convalesce in place if necessary. We're going to take turns as family, but we're going to pay for aides part-time. We're going to pay for skilled nursing if we can't get it covered otherwise. And it's often a real hybrid of approaches to be able to provide for people to stay in their home. It's not always possible, depending on what the needs are of that particular individual. It wasn't possible for my father-in-law, who just passed away in October, and he did end up having to be in a nursing home for that last year. And it's particularly often not possible for cases like dementia, where they can get to the point where they wander or where they start injuring their caregivers. And unfortunately, as an EMP in my community, I've seen that happen, where it's just not really wise to be keeping that person at home anymore. It's not benefiting them, and it's not benefiting the family when they're stressed when the person's wandering outside on a day like today and nobody knew how they got out of the house or where they are, or where they've in fear hit or worse their caregiver. And sometimes you do have to think about we keep them at home and we're able to provide for them as best as possible for as long as we could, but now we have to think about something different, and that can be hard. It's obviously hard, not just on the financial side, but the personal side. There are some good resources on long-term care.gov. And if you are considering the insurance, definitely talk with your insurance agent. So I'm going to leave the retirement and healthcare at that. And I think if we could just see if there's any questions out there or comments, we'll adjust that, and then we'll get to Nick and the taxes. So do we have any questions out there? Feel free to open your mic if you have anything you want to bother putting in the chat, but want to speak up. Anybody out there? All right. Well, if there are no questions, if anybody thinks of any towards the end, we can come back to it. But now we'll bring on Nick to talk more generally about all the different taxes you might need to consider.
Thank you, Mike. Let me just share my my slides. Hopefully you're seeing my slides come up. Mike does a great job talking about retirement. I'm one of the tax preparers that'll push you to contribute to your IRAs and your SEPs and all that. Dying on the tractor is a great retirement plan. As some of mine that I push to give fund the retirements, it's nice to have that be your goal, but it's also nice to not have that be the only option. And so that's why I really push people to do the retirement stuff. So, but today we're going to talk about some tax, I call them opportunities with the farm transfer. I'm happy to take any questions and dive into any kind of specific tax issues, maybe take that off to the side. You're welcome to chat anything. My name's Nick Bullock. I'm an enrolled agent to practice for the IRS with, and I work for Farm Credit East. I've been with them for about 12 years now, going on 13. I specialize in agricultural world, everything from dairy all the way to vegetables, timber, maple syrup, you name it. I kind of specialize in partnerships and S corporations and LLCs, the business side of it. I also help a lot with the farm transfer planning and getting people, everybody to the table and kind of addressing the transfer and what the tax impacts could really hit. Before Farm Credit, I ran my own practice for about 10 years. So I've been doing taxes now for about 23 years. Thank you for joining us today and sticking around for the tax talk. A lot of people start yawning and sleeping during this time, but I'll try to keep it as informative as possible. So, you know, when we look at taxes when transfers, there's a lot of things that come into it. Mike talked about long-term care. A lot of times there's, you know, the gift, the estate tax, there's income tax that comes into it. We got to look at the cash flow. Can, you know, this operation be transferred between generations or outside investors and pay for everybody to do that? A lot of times when I talk to people, they want to make sure that the transfer is equitable versus kind of what people sometimes talk about. It needs to be equal between the generations. They got many sons, daughters coming into it, and just making sure that the people that came back to the farm, that are working on the farm, that sweat equity isn't overlooked and the transfer is equitable. That's not always the same thing as being equal. With the gift estate, you know, the farm, the younger generation inherits the farm, and if you're over the estate and gift tax thresholds, the IRS gets a pretty hefty sum of change with that. The threshold the last couple of years has been pretty generous. We haven't had to worry about that. That's all kind of maybe sunsetting in 2025. That's more of a to be determined. We imagine that we'll get some sort of legislature that'll change that number. But if nothing, they don't do anything in 2025, the married filing joint kind of gets knocked down almost by half. So, you know, $12 million estate's a pretty big estate still. So most people wouldn't be hit with any kind of estate taxes. But it's something to watch out on for the horizon on some of these bigger kind of farms and why planning is so important. Another consideration is that if you're living in one of the states that has a state estate tax, that could be triggered a little bit more easily hit. especially with property values. The state of Vermont is now $5 million. It was 2.75. And so we'll see if that changes in future. But it's something that us kind of tax geeks kind of keep an eye out for is estate tax problems. For the 2024 year, the annual gift tax exclusion is up to $18,000. It was $17,000 for last year. So you can give any one person $18,000, and if you're married, both of you can give $18,000 to that same person. So bringing the gift up to, say, a married filing joint return to a descendant or anybody of up to almost $36,000. So that's come up a long way since the $10,000 number as it was when I kind of came into the business. The income tax on selling the farm. If you buy the farm, the younger generation comes up with a price. They buy the farm. The older generation gets the money, but then they have to pay the tax, right? And then depending what they sell and how they sell, and how the deal is structured, that could be a significant amount of money. I'm going to talk about installment sales, and I've got an example about, incorporating the farm sale in a few slides here. So, the sale, we got to worry about, the gain on the sale and what, the basis is. We mentioned basis. Mike mentioned basis. I'm just going to cover that real quick. Basis is whatever. There's kind of a couple ways you can get basis. One is the traditional way. You buy something, so you have the basis of whatever you bought it for. So I bought a farm, the land and the barn. So I bought the whole thing for $500,000. The land we said was worth, $200,000. The house that was sitting there was $100,000. And then the barn had, the difference. So we have different bases in the different assets that we buy, even if it's one purchase price. Now, if the younger generation buys the farm, their basis is whatever they paid for it. And then the older generation, or who's ever selling it, they're taking the sales price minus whatever they bought the farm, their basis in it. And that's going to be the net profit on what you're going to get taxed on. We're going to talk a little bit about depreciation recapture and things like that. But when you sell a farm or an asset, that's the basic structure of it. Sales price less basis equals the profit that you get taxed on. I mentioned depreciation recapture. So during when we're in business, we buy assets. Those barns that was part of that example. We depreciate those over the asset life to help reduce our taxes. Basically, we're taking the expense over its lifetime instead of taking all that expense in 1 year. In depreciation, we can expense things accelerated. There's a couple different ones. They call it Section 179. I'll try to refrain from using code section in my talk. It's a great way to get people to yawn, but that's a pretty common one most people have heard of because it lets us expense depreciable assets at a faster rate than what they normally would be. Now, land isn't depreciable because they don't make any more of it, so typically that appreciates in value. Barns and things like that are technically going to be a longer life of a depreciable asset. The agricultural community, we've got some caveats where some assets that, a barn that I would be usually using and have to depreciate over 20 years. But since I'm using it as a dairy facility and it's only for single purpose ag structure, we get to depreciate that. That qualifies for that expensing, that 15-year property that we can depreciate all in 1 year if we need to for tax reasons. Hopefully not to just not pay tax, but to really figure out your whatever fits into your tax plan and your business plan. On the slide here, I've got capital gains. Now, capital gains is the tax we pay on certain assets that qualify for long-term rates. So we have ordinary income and we have capital gains rates that are in our tax code. Now, ordinary income is, W-2 income, self-employment income. It's that ordinary income tax rate that we get. And it depends how much money you make and whether or not what tax bracket you fall into. They call the tax brackets that we're in marginal tax brackets because you pay, think of it as little buckets that you fill up going up. So each bucket going up the rates you fill up that to a certain income level and you pay tax on that. And then you fill up the next bucket. And we say the last dollar that you end up in say like the 22% bucket, that's you pay tax gradually up into those buckets, and the last dollar landed you in that 22% tax bracket. Happy to field any questions on that. It can be kind of a complicated thing to explain. Capital gains is kind of taxed at a different rate than our ordinary income. So if we're in a certain tax bracket, our capital gains can qualify for a beneficial tax break. So if we're in the 15% tax bracket, a lot of our capital gains taxes at the current legislature are going to qualify for 0% tax. So we're not going to pay any tax on our capital gains if we're in the 15% tax bracket. So, capital gains taxes is similar to ordinary, but it gets us that preferential tax bracket and can qualify for tax-free transfer. Those kind of go from the 0%, 10, 15, 20, 25. You can get it all the way up into collectibles at like over the 30%. So both the income tax and the capital gains taxes are on a sliding kind of marginal tax bracket scale. When we sell a business asset that we've taken depreciation on, we have to pay that depreciation back that we took, that benefit that we got. When we sell that asset, even though we can get some capital gains treatment, when we sell that asset, whatever we took as depreciation, we have to recapture as ordinary income first before that gain on that sale can qualify for capital gains treatment. Big thing to look for in when we're structuring these farm sales, depreciation recapture has to be recognized in the year of the sale. So if I'm going to talk about installment sales down the road. When we have the cash flow of the deal, when we're selling a farm, maybe the younger generation is buying the farm, and we've structured it so they're buying the equipment as well as the land. The land's going to have that capital gains treatment. The equipment is going to have that depreciation recapture. That can have a pretty big tax bill in the year of the sale that there might not be cash for if we have elected to use an installment sale. So, you sell everything for $100,000 and $50,000 of that is the equipment. And we have, say 25% of that. So maybe like a $10,000 tax bill, but you're only getting, $1,000 in the first year payment. So now you have a discrepancy of a $10,000 tax bill with only $1,000 worth of cash to pay it. So something to very much plan for in these things, and why it's important to try to get everybody at the table to understand the implications of all these deals. I mentioned something about the cash flow. Sometimes the older generation, they're selling pieces of the assets. Sometimes we're looking. Mike mentioned the rental. We want to make sure that the business that we're transferring has enough, income to be able to afford both generations on it, be able to afford the exit strategy to bring a good retirement for the older generation and a livable wage for the younger generation. And there's always, belt tightening that can be done, but to structure the deal in such a way that everybody can thrive. I mentioned equal versus equitable. When we split the farm, when one child has invested a lot of time and energy, maybe they haven't taken a paycheck at all. For I'm going to get the farm down the road. We need to have those conversations to make sure that the family unions are everybody's being addressed. That sweat equity that we've been talking about. If it was equal, the person that was off the farm, and if we ended up in probate court, you just had a will. Hey, we split my assets 50-50. One was expecting to get the farm and one was expecting to get the IRA accounts. The court might decide, hey, the fair market value of the farm is this, the fair market value of the retirement accounts is this. That's not equal. We're going to make it equal. And it can put an undue burden on somebody that's trying to move the farm into the next generation, having to write a big check to brother, sister when they thought they had a lot of sweat equity involved. I'm going to talk a little bit about trust and estate planning and that kind of thing in future slides here. But this is the idea of the equal versus equitable. Just because an estate has to be, it's important to be equitable, doesn't mean that it has to be equal. I get asked a lot, well, what entity, how should I structure this? Is there a way to tax-free, get all my stuff down to the younger generation? Sometimes there is, sometimes there isn't. A lot of people look for, the S corps. In business, the IRS recognizes 4 things you can be. You can either be a sole proprietor, which can be an LLC. You can be a partnership, which also can be an LLC. You can be an S corp, which can also kind of be an LLC too. So the term LLCs can be moved around, and it's under state law that we get these LLCs, but it's important to know what your tax structure is going to be. The 4th one is a full corporation. So you can be a sole proprietor, 1040 LLC. That's just you doing business. You could bring in, say, the younger generation or your spouse and move it into a partnership, which has more than one member. And then you can elect any of those to end up being in what's called an S corp, which is the in-between stage between a partnership and a sole proprietor and the corporate filing. We like LLCs here at Farm Credit because they're very versatile. We can set them a sole proprietor. We can be a partnership. They let us have, especially in the partnership world, where we can transfer assets using profits interest. We can do it by gifting, kind of moving the assets into this LLC that gives you protection for your stuff, but also gives a way to report in a tax way the profits of the business in an equitable way. So one thing that when I start talking farm transfer with people, and I'm sure this was covered in the past, and I know Mike mentioned it, is to having the 5 kind of instruments that are needed to really make sure that the transfer happens well in your lifetime. So there's wills, trusts, the power of attorney, the living will, and life insurance. Mike talked about the life insurance, and I think you mentioned the living will. That's kind of the durable power of attorney. It's important to, if you don't have a will, make sure that's the first step, is make sure that you have a will. Otherwise, the state will, upon your passing, will kind of create one for you. And you got to go through probate, and that can be very public, but they're going to take a look at the total value of the assets, see who's needs to be benefits, and really kind of make those decisions for you. When you write a will, you tell the court, hey, I would like this to happen. And it's pretty straightforward, but it still can put a stop on, like, say, the entity. If you have a partnership and your dad's 75% partner and the son is 25%, and the partnership says, hey, on my death, this goes to the son, you still have to go to probate and get assigned and clear the probate for them to clear the estate of your will, so you can continue doing business. It can put a real, the milk check comes to, the LLC, but it can really put a stop on the bank accounts and all that when a partner passes away with just a will. We like trusts because they're very similar to will. They're like a forward-thinking will. Upon your passing, it's already been filed with the state. Your wishes are now being carried out by the executor of the trust. The trustee of the trust is the proper term. You set them up when you're alive, and they're a revocable trust. So you can, you're still managing it. You're there. It's your revocable trust. And when you pass away, it becomes irrevocable, and it sets in the stone and in motion right as soon as that we pass away. Whoever is the trustee of that trust can execute the way you want it to happen. The bank account and all that doesn't need to go through probate. And a lot of the time partnerships can continue doing businesses a lot more smoothly by using trusts. The power of attorney, we ran into this morning with the durable power of attorney, trusts, and all that. We have a partnership where mom was the general partner. She was limited partner. The sons are much lower percentages. we were trying to figure out how to, transfer more interest to the boys. And then all of a sudden, one of the sons goes, "Mom's starting to show some signs of dementia." And that can throw a real wrench in all the planning that you got going on if your general partner, person that's in charge, doesn't have these kind of documents in place to let you know what to do in case they cannot make these decisions anymore. And it could really, in this case, it could put a full stop to their partnership. They're going to need to reach out to lawyers and really delve into this to see what happens to this partnership now that mom, it might not be of sound mind to make these decisions. So the rest of my thing, I'm going to talk mostly about the taxes and how we transfer ownership of things. So there's really 5 ways that you can acquire assets or pass them on. You can give it, you can sell it, you can leave it, earn it, or a combination of all 5. So I'm going to kind of go through that when I'm talking about with those. So when we give it, there's there's no estate or gift tax due unless the basis of the gift exceeds the taxable limits of the estate and gift tax. So this year you can give $18,000 to anybody without filing any kind of report. What's called the lifetime gift exclusion is using up that 12 million or 22 million if you're married or filing jointly, lifetime exclusion of gifts that you can use up. If you give, say, $30,000 to somebody this year, you won't owe any tax, but you should file a gift tax return to let the IRS know, hey, I'm using up some of my gift tax exclusion by giving away more than the $18,000 that you say I can give away annually to anybody I want. This is a pretty straightforward way of giving assets away. There's pretty much no reporting unless you exceed those thresholds. One common problem that we have with somebody that wants to just give away the farm, say, is that you might still incur some expenses because when you give away land or business assets or any kind of assets that's not cash, the IRS wants to know what the fair market value of that gift is. And that can trigger needing an appraisal, which can be very pricey these days. It's a very straightforward way of transferring assets. The basis of the new asset to the giftee that becomes the donor's basis. So whatever mom and dad paid for the farm, if they give it to the son, his basis is whatever their basis was. So if they bought the farm and it was $100,000, mixed between all the assets, whatever their basis was, son now has a farm that might have a fair market value of $5 million, but his basis is only $100,000. I run into this a lot where people are like, well, we're never going to sell, so it's not a problem. That's fine too. It can be a big problem if you have unforeseen circumstances. If mom, dad give the farm away and then they pass away less than a year later, and the younger generation, they miss out on something that I'm going to talk about in the next slide, is that step up in basis. If they went to sell that farm, now it's worth $5 million and their basis is only $100,000, they're looking at a pretty sizable taxable event. Sorry, I think my slides got a little mixed up here. So if we sell it, there's a taxable gain, depends on senior's original basis and how much was depreciated. We talked about that depreciation recapture, which can be a real big stick in the mud if we go this route. Junior's new basis, what he gets to depreciate things for is what he paid for. So it's pretty straightforward as well. So I'm going to talk about some strategies. We have that installment sale that I referenced earlier, using the sale price allocations to minimize tax. We want to make sure that we highlight the personal residence. And don't forget about, unharvested crops in the sale. And Mike did a really good job talking about development rights. I'm going to touch on that again real quick. And I have an example here. So like we have a $1 million farm sale. We have $350,000 for the land. we've allocated $200,000 for the principal residence, $100,000 for the barn, $150K for the equipment, $150,000 for the cows, and then we have $50,000 for those unharvested crops. So we have kind of a big kind of project here where we're transferring over and what different tax things can land you in. So each one of these is going to have a different taxable event that kind of is associated with it. Some of the key considerations, there's some good. There's the capital gains. There's the sale of the principal home exclusion. The sale of the principal home is pretty straightforward. If you've lived in a home for 2 out of the last 5 years and you meet the criteria, up to $250,000 single, $500,000 married filing jointly of the gain. That's the sale price less basis of that transaction is going to be tax-free. It's a wonderful code section, and it helps a lot of people retain that home equity that they've been working on so hard all these years. Installment sales are really great. We can set those up. You still got to charge interest, but like Mike mentioned earlier, the applicable federal rate is not what current interest rates are. It just the time value of money, the IRS will automatically say, hey, if you didn't charge interest, you got to at least pay this much. Installment sales are really good, but the one key thing with that installment sale is that depreciation recapture, that has to be recognized in the year of the sale. So if we have a deal like we're talking about here with $150,000 worth of equipment, if that $150,000 worth of equipment has fully depreciated, that part of that deal is going to be part of the ordinary income, which can create a pretty sizable tax due. And then I mentioned here about hot assets. These are assets that are used in the trader business that would have been part of your cost of goods. So like in a hay operation, the unharvested crops, those need to, that $50,000 of this example would actually still go end up on as ordinary income subject to SC. The capital gains can give pretty big advantages for the taxable brackets and the sale of assets. That land, hopefully we can, soak up some of the basis, and depending where we're at with the installment sale, we can kind of help control where your AGI ends up and where your taxable income is. That gets you qualifying more of that gain each year for capital gains treatment. So in the year sale, you might have a big tax bill because you have that depreciation recapture. In the years down the road, where we're actually recognizing the income from the land and the land sale, that would qualify for more of that capital gains treatment. So a lot of times we'll schedule the deal so the land is the only thing that is part of the installment sale. The cows and the home are the assets that we sold this year. And so we kind of we call it defer the income down the road of that land sale into years where you'll have a lower tax bracket, so you'll pay less tax. So we can spread that taxable gain over many years to maximize that capital gains rates. The bad in my example is that depreciation recapture. I can't bang that drum big enough. Sometimes I find with a lot of farm transfers, it's best to give the equipment away than it is to try to sell it. The younger generation sometimes can lose out on that redepreciating for what they bought it for, but that can kind of almost far out the tax what the older generation would have paid on selling it. Kind of can far outweigh that benefit, that redepreciating that equipment. And you got to watch out for something called anti-churning laws when you're dealing with families, because selling junior assets and buying it back, you might not be able to accelerate the depreciation on that, which some people hope to. Hey, I'm buying a $100,000 tractor from dad. Well, you can't depreciate it all this year. You get it, but it's over 5 years. So you got to watch out for that. And then also watch out for the self-employment tax assets that won't qualify for capital gains treatment. So let's revisit my example. So we have that $1 million farm sale. The land that qualifies for the capital gains. That's really good. It's on the plus side. That principal residence. We got to make sure that we carve out part of the basis and the sale price for the farm sale there. because it's a great exclusion. So $200,000 of this example, you won't pay tax on, which is a really big plus. The farm buildings and the equipment, they're kind of handled this differently when we talk about depreciation recapture. I won't get into the complete weeds on that, but it's important to have that depreciation recapture on your radar, because that can be the biggest part of a farm sale tax bill. So if we have $150,000 worth of equipment that we're recognizing, income on, you could pay almost 25-30%, and making sure there's enough cash in the deal to pay that, and for all the other things that you want to accomplish with this farm sale. Dairy cows are nice if they're raised because they qualify for capital gains treatment. If they're purchased, we got to watch out because they can also be subject to depreciation recapture. And then I mentioned the unharvested crops was the self-employment income. That's a lot to take in. After I talk that through, most farmers are, hey, I'm just going to leave it all. Junior can work here and he gets it all when I pass away, which is a valuable way to have it. And actually, it's when you look at it versus giving it away, it gives the younger generation quite a benefit. So there's no estate tax due unless it exceeds those, estate tax limits that we talked about. Junior, he doesn't have to pay any tax on inheritance. That's great. He also, instead of in our example where I mentioned that he was given it and then Pops passed away, he had the capital gains of that massive disparity between what the basis was and what the fair market value was. Well, if he was left it in the inheritance, they get what's called a step up in basis. So it becomes the fair market value at the time of death. You can choose a different day out of 6 months out from the time of death. But typically at that point, it's great to get an appraisal or have land's a little easier. It's a little cheaper. You can get a real estate person to come in. Sometimes we use the property tax evaluation, but typically that's going to be a little low in these days. As far as a step up in basis. Now, if they go around and turn around and sell that asset then a day after they receive it, a lot of times we just use that as the fair market value because this is what the market paid for it. And that step up in basis is a huge thing, and it applies to equipment, all that kind of stuff. So when you look at giving the farm or inheriting the farm, from a tax standpoint, inheriting the farm is a better tax strategy. Again, relatively straightforward. It's either going to go through the trust or it's going to go through the court, depending what they have set up in those kind of things that I talked about with wills and trusts. There's another way. So we don't want to give it. We don't want to sell it, and Junior doesn't want to wait till everybody passes away. We can set up what we talk about as an LLC, a profits interest LLC, and it's basically a partnership between the both parties, and we can kind of turn the equity faucet on off as much as we want. And when we talk about a profits LLC, is the profits in the LLC can be allocated to the younger generation because they don't have as much equity in the business. So, typically the old generation is going to be putting in all the equity, all the stuff, and the younger generation's got their sweat equity. So they kind of come in with zero. And over time, if we allocate all those profits to the younger generation, they get transferred that partnership by the profits in the business. So the younger generation basically pays tax. It's got to be a profitable enterprise. And their value ownership of those assets will go up over time because they're paying tax on the profits and they're also sharing in the appreciation of the business. So they're paying tax on the profits. So if they have $100,000 worth of profits and they say 75% is going to Junior, he might be paying taxes on $75,000, but the equity in the business is going up by not only that amount, but also the amount that the assets are appreciating. So over time, this slide, what we talk about is we set up a profits interest, but that's not the only tool in the toolbox. We can give things, we can leave it, we can charge rent, so I talk about a combo of everything to make this, a farm transition work. In the next couple slides, I talk about this profits interest. I'll go through them really quick. I don't want to keep everybody from their lunch. This kind of gets into partnership taxes that is a little heady, but
So Nick, we've had a few questions, and I'm wondering if maybe before we go into that, we go back to some of these.
Great place to stop. Sure. I have not been keeping an eye on the chat, so.
Yeah. So first, I just want to comment that, so Nick will go through on profits interest LLCs. There's also just the capital interest LLCs, which is I see as more common in thinking about transferring this capital interest, which could be transferred through the ways that Nick's been describing the capital interest through you can leave it, you can gift it, and they can purchase it. So let's see. One of the questions, and first question here was, when does it make sense to let the younger generation inherit the farm at the stepped up basis versus an installment sale purchase, which is actually, I think, more than just those two options, right? So
you got lots of options, yeah. But when does it make sense? That's a case by case. Junior's 20 years old, Pop's 50. Hopefully Pop's going to stick around for 50 more years, right? We typically will keep the way I like to structure these is, we put the cows and equipment into an LLC, typically a profits interest. Everybody gets into that, but we keep the land in dad's name. And as time grows, where the business becomes more profitable, they can pay rent to dad, and that can supplement his retirement income. And then when he passes away, the son inherits, or the descendants inherit the real estate with that stepped up in basis, which is really good. But over time, the actual operating entity that has the equipment and the stuff where you're making the business, that has slowly transferred over to the younger generation. I kind of go over that in the next couple slides, but how it makes sense and when to do it. A good plan is always going to be changing, and it's important to get it in place now, because you never know who's going to get hit by a bus when. And if you're going to get in business with somebody, having those kind of exit strategies and that business plan that grows with the business is important.
So I'll add that I have this conversation across the table with people quite a bit, because as Nick pointed out at the beginning, this stepped up basis is only important if you are selling the farm. So a lot of the families, the thought is, we're trying to keep this farm in the family. So when we're not worried about the tax liability of our daughter or our son selling the farm after we die, because we don't want to see that happen. And as a matter of fact, some of the non-farming siblings might be fine with the farm being left to their brother or sister, because they're going to keep farming it. And if they knew that they were going to just cash in later, they wouldn't want them to do that. And so if we're not talking about a farm sale afterwards, there's no value to the stepped up basis. But as Nick pointed out, the reason that people would maybe try to protect that is the eventual, the possibility that they might have to sell it. There's something that we just don't see that's coming. And so that is something that people talk through and think about. Most people say, well, then they'll figure that out because they're getting a big gift. If in Nick's example, he said $5 million farm at that point, which of course would be very high, but even $1 million farm, right? If they inherited $1 million farms, even if they're paying Uncle Sam a big capital gains on that sale, they're still further out than if they ever had to buy it through an installment sale, or going to Farm Credit or FSA to buy it earlier. So they're still better off.
Or if they want to sell like a 2-acre parcel to, there's 2 acres that is perfect for a house lot. And if I had that stepped up in basis, it would have been all the equity would have been retained by the farm. Whereas if I have to pay taxes on that 2-acre parcel that I'm, carving off to fund my operations, that can be a lot of money.
And I'll just give one more example before we go on to other questions. One of the very first farms I started with 17 years ago, doing this sort of thing. So, was an organic dairy farmer here in Vermont. He had owned the cattle and equipment for 10 years. And he said to me, I might have given this example earlier on because I use this frequently. He said, I've owned the cattle equipment for 10 years, but I haven't poured an ounce of concrete on this farm, or a bunker silo or manure lagoon and a heifer barn, because I don't own the real estate. My parents don't have wills. And of course, that was one of the things. The estate plan was like one of the top things to figure out. In the course of going through many, many discussions and also discussions with the non-farming family members, siblings there, the conclusion was that he would inherit most of the fields that were going to come to him and not to a sibling, which was most of the cropland. But he was going to be gifted farmstead and about, I think, 25 acres, because then he would own it. Then he could use that for collateral as he went to go borrow money and make capital investments to help increase the efficiency of his business. So holding on to it with so he didn't care that he didn't get he wasn't going to get the step basis, that he was being gifted his parents' basis. It was more important that he had control of the land, wasn't have to worry about other heirs, and was able to make his own capital investments in it. And I think that's just an example where Nick says it really depends on the situation. Now, I do see a hand raised from Ellen Fine, and I don't know if that is related to this question or another question that we can come back to after we've gone down the list.
It's a different question, but it's generally obviously about this topic, but I can wait for other folks' questions to get answered.
Okay. So let's just go down the few others that went in the chat earlier. Is there any benefit to gifting shares or partial ownership over time up to the annual value of 18,000?
Of course. A wonderful way of transferring ownership, especially if you don't have a partnership that is set up as a profits interest. If that's not maybe a lot of farms don't enjoy paying tax, so they don't want to have a profits issue. But they still want to transfer ownership through the LLC kind of structure. You can set it up to give a certain amount of the capital interest every year up to that 18,000. Now, figuring out how much the partnership interest is worth, that can be kind of a math exercise, but it's definitely a solid plan.
And I would just say too, that's a common strategy, and including, because you've got that now it's 18,000, just went up, but you can gift that to multiple people and multiple multiple people can gift to the same people too. So it's what we've done in a few situations is where mom and dad have an interest together, and so they each gift $18,000 to, they might have two of their children in the business, and so dad is gifting 18,000 to one of those two children and 18,000 to another one in the equity capital interest in the business, and then mom is doing the same. So each one of those partners. So now you've gifted 72,000, not have to file any paperwork.
Yep.
And as Nick said, if you even want to go further than that, you just need to be filing this gift tax return, and there's no tax due for either party.
No, it's just valuing the gift that becomes the issue.
Right, and particularly when you get into real estate, that can cause a problem if you're
without an appraisal. Yep.
Where you might be undervaluing the real estate. Now we have a question here that's specific to Maine that I'm not sure if you're going to be able to answer. Maybe you can look at that in the chat.
I might be able to.
And while you're doing that, I'll just mention. So there was a comment earlier too, just about that we keep talking about the federal estate tax has these very high limits, and each state estate tax has a different thresholds. In Vermont's now 5 million. First, I want to just point out that's net value on the estate. So if you could have 6 million assets and $1 million in debt, or $1,000,001, and that gets you below that threshold. So it's the net value of the estate, not just your total asset value. So a lot of farms, you know, they get to a certain point where they have a certain amount of assets that are going to cross those lines, where they have a debt there that could bring it back down. Point that somebody made in one of the comments earlier was just how Massachusetts has only $1 million threshold, and that's pretty artificial when the real estate value, even for conserved farms in Massachusetts, is going to be very, very high. So that's where a different kind of tax strategy that may have to be considered, and shifting it beforehand, I think, might address that. Or selling it ahead of time. That question, is there anything that you can answer as far as the question of Maine, Nick?
Yeah, Ellen, I'm not a lawyer. I'm a tax guy, but it looks like for real estate that this would keep you out of probate, and yeah, it looks like a good way to get around some things. But it looks like it's just for the real estate. So like a partnership interest, depends what's being transferred and what you're trying to achieve with the plan. So if it's just about the real estate, this might work. But I'm not a lawyer. I'm definitely not familiar with Maine laws.
So the last one in the chat right now, I believe, is from Beth, who says, you have a link to explain the installment sale further. Do you have any?
I can speak to it a little bit. I might be able to come up with a link. It'll probably be an IRS link, so I don't know if it'll explain things. It could be some heady reading. Installment sales are any kind of deal where you take just $1 of the deal has to come in a future tax year. So any kind of sale that's not completed in the year of the tax can qualify for installment sale. And it's basically you holding the note for, a lot of times people like buy a car and it's financed through a finance company. With an installment sale, you basically can report the sale as you being like the bank. A lot of times people are the bank, or that they've got something structured, so farm credit or the lending kind of works out in a certain way. A lot of times people choose not to report an installment agreement, even though the actual sale is happening in an installment way, because there's no tax benefit for reporting it that way. Like for instance, we sold $100,000 worth of equipment. Well, if it was only $100,000 of equipment, it wouldn't qualify for that installment sale because it's all depreciation recapture. But if it's $100,000 worth of equipment and $25,000 worth of the cow sales that do, that $25,000 could qualify for the installment sale, but it doesn't affect your taxes. So why don't report it all in the year of the sale? There's a lot of different ways, reasons why that you choose to do an installment sale. But typically you do an installment sale, so some of that income is shared over many years. Thus, tax on $100,000 in 1 year is going to be a lot more than tax on $20,000 over 5 years, because you'll be in a lower tax bracket. I hope that answers your question.
Basically, it's seller financing, and it could be done for these tax reasons, or it could be done because you're trying to help out that next generation successor farmer by having favorable terms, maybe again, being very cautious about making sure that doing the due diligence to know that this person is going to be capable of making those payments to you, because you're taking on the risk otherwise a bank would take on. But sometimes there are people that aren't quite bankable enough, that you still trust enough that you could still provide some of the financing to that next generation and feel comfortable with it, that you're going to get paid. And again, you have all the legal paperwork so that in place is important, so that you can foreclose if you need to, if they default. It's usually about trying to help them out and being able to finance it. In addition to the potential tax benefits of the spreading out the capital gains. But as Nick keeps coming back to, you have to sit down with the accountant ahead of time. We'll figure out if there's a depreciation recapture that's going to have to be paid in year one of the installment sale, and then not afterwards. And that's where Nick is cautioning that sometimes the payments built into the installment sale don't cover that depreciation recapture tax, but they might. It depends on the sale and the depreciation recapture. And then sometimes, and we'll go forward with this all the time anyway, because they may be getting, they may have other savings and they may have other income because they're selling other assets not through the installment sale. And so I think this is one of those things where it depends, and you got to talk to you got to look through your situation with your tax advisor, which is part of, I think, with all this legal and tax stuff. We always say we can only answer so much in these webinars, but
That's right. Yeah.
so,
Ellen, did we
so
cover your?
and fine. So now we have the question still.
So this is, I guess, the other Ellen on the call here.
Yeah.
A lot of, like, I'm in Eastern Mass, a lot of some suburban, some urban farming, market gardeners, small veggie farmers, fruit growers, flowers, whatnot. There's definitely, animals being raised here, but a lot of us are going into this really small 1 to 2 acre kind of farming situation, maybe 5. And some of us are choosing to grow in like a cooperative means, where it's not like the traditional kind of old-fashioned model of the family farm, but it's like a group of people getting together in a cooperative, or also there's some land rematriation going on to indigenous people whose land we're all farming on, and other kinds of public trust, community trust. So I feel like I want to ask for you to do like a whole other presentation based on the taxes and the transfer, so we combined all those wonderful idealistic efforts with like some really sound economic things in place, because we all have those great ideas of how to farm that way and grow food that way, but when it comes down to it, we're going to need this kind of help too. And some of this is applicable to us, but a lot of it is not, just because of the nature of the things. So I'm just wondering if you could comment a little bit now and kind of like go, okay, maybe another March, webinar.
Sounds like you want a farm tax webinar.
Like I want to farm what?
Farm tax webinar.
Well, really more like for that cooperative growing thing where it's not family to family. It's like, let's say you have a person who has some land that they're going to gift, or let's say a community has like 4 acre parcel, and they're like, you know what, we really want to see food grown here. We want to create our food security for the community. And it's just going to be a different model of, maybe not even owning the land, but maybe owning the land. And so, I'm just kind of wondering what we can do for that model and give all of this, the great economic information, so that we can do that with financial and as well as food security success.
We've definitely done a lot on cooperative farming models and such. I think a lot, until you get into the nonprofit world, which is the whole, the nonprofit has a whole different tax or lack of taxes structures, right? So it really depends on how you're structuring things. Because if you are, you even mentioned if somebody's gifting the land, and that's part of, the same aspects apply, unless, there might be some differences.
Right, that part I understand, but what if it becomes like a little mini LLC? And so you are, or whatever kind of for-profit tax structure, but it's come about in a way of cooperative farming versus one farmer to one farmer, or one farm family to one farm family.
Nick, you can chime in here, and then we probably should move on. But I think we're looking. It's still an LLC with multiple parties, and we're working with non-related parties all the time. And it's if you're setting up an LLC as a for-profit business, it's all same tax issues going to apply, whether it's.
I deal a lot with a lot of these. When you take out the land, if it's just being an LLC that's being run for profit, I've also got some that are nonprofits, so, farmers markets and things like that. It all depends on the structure and what you're all trying to accomplish, kind of at the end game, what you end up doing in your business plan. So that can get very, like I said, you can fall into the nonprofit world, which is there's still a lot of reporting that needs to be done. Or if you're in, a profits LLC, and you're all partners, or if it's an S corp, there's shares. There's a bunch of different ways that they can be approached. But I'd love to talk about that kind of taxes. Maybe Mike will have me back.
Yeah.
Thank you.
I think too, one place where it might differ from like my farm, which is my partner myself as a LLC, as a partnership, is probably more so in the operating agreement rather than in the taxes, like how you're going to deal with people coming into the LLC, people leaving the LLC.
Mm-hmm.
Those things are probably going to be more consequential with the more parties you add in, the more complicated that's going to get, and the more rock solid I think the operating agreement will need to be. And yeah, so that will probably guide the rest of it more so than if it was a simpler business structure within a family or a couple of individuals.
So
Thank you.
Welcome. So I think two quick questions, Nick, that I wanted to ask, and then maybe if you had some more that you wanted to still present on, then we can get back to that. What the one is, what with the real estate sales you mentioned, there is home portion of it where there is the home exemption. It's 250,000 per individual in the married. It have to be married couple. Is that correct?
Yeah, married filing joint.
I finally jointly. So do they, or does the surviving spouse lose that other 250,000 exemption if they end up being a widow or a widower before they sell the farm?
Probably not going to be an issue because they got to step up in basis.
Okay, because they inherited the share of their deceased spouse at the step up in basis. Okay.
Yeah.
That makes sense. And then I just wanted to touch on this because you talked about different structures. My understanding is to never put real estate into a corporation, S corporation or otherwise, or an LLC filing taxes as an S corporation. Is that correct?
That still holds pretty true. The reason for that is what is commonly known as double taxation. You definitely don't like to see real estate in an S corp or a C corp, because what happens is that you hold it in for resale. This is really, if you're going to sell this piece of property down the road, because it doesn't qualify for that step up in basis if it's in the S corp or the corporation, the stock in that S corp would qualify for it. But once you sold that piece of real estate, that S corp flow through, or in the C corp where it pays its own taxes, is going to pay tax on that capital gains, which is okay, fine. But that cash stays in the S corp. Well, say we want to get that cash now out. Well, it can only come out as a dividend. So now you paid tax on your personal taxes on an S corp. So it came through as long-term capital gains. So I paid tax on it. And then we want to get that cash out. Now the K1 shows that I have a distribution of a dividend, and now I'm paying taxes on the dividend of that same cash. That's what they're talking about with that double taxation. Not saying that you can't do it. There might be reasons to do it this way. But typically we like to keep the land that we kind of refer people to, we keep it in partnership or sole proprietor LLCs because land's a little easier to get in and out of without that double taxation.
Right. So where I've seen some cases where they have a business where there's tax reasons to consider the filing taxes for the business as an S corp. So they'll have one LLC for the business that's filing as an S corp, and it's renting the farm from either the individuals that still own it as tenants in common or tenants entirety, or from another LLC that is just holding the land and is filing as a partnership.
I like that structure.
Yeah. So I think we've run through the questions. If there was some things in the last 20 minutes here or so you want to cover.
Are my slides still up? I'll blow
Yes.
through them. Basically, it's just I'm recounting what I've already talked about. I'm from the old school. You say it once, you say it twice, you say it a third time. Maybe somebody will remember what you're talking about. Yeah. So, I've got this AB. They want to transfer 50% of the business. They can sell it. They can gift it, or we can do that profits interest LLC, earn it basically. The problems with the selling it, large taxable gain. Maybe the person that buying can't get the cash flow to buy, finance it or purchase it. maybe the timing doesn't work, and then you have that depreciation capture issues from selling it. Giving it. A wants to give it away. Well, he's worked hard for that business. Why should he give it away? They might be giving up the estate tax, what I call permanent tax benefits. The benefits that are written into the tax code, like the standard deduction. That's something that you want to maximize using that every year. So you're using up all your permanent tax benefits. Well, the estate tax gift exemptions are part of those. One of the problems with gifting is with the old way, you could only, when I first started, you could only give like $7,000 away every year. Things moved a lot slower. $18,000 per person. Things get to move a lot quicker, especially when you got a family of 4 that's coming on. Excuse me. Another reason that giving it, B might not be ready for it. I've seen this a few times when we've given the farm away. They just weren't ready, and maybe the siblings don't resent it. So. We like this earning it. There's no recognition on the gain because, dad, the old, I keep using the father, son, or mother, daughter. Anybody can get into a partnership with anybody else. So, the one that has the equity puts the equity into the business. The one that's trying to take it over, it doesn't bring as much in. This preserves a lot of the gift estate stuff for the person that's putting that into the business. They still retain, the rights to tell what's happening with that stuff that they put in. The person coming into that LLC, they're incentivized to that they're earning something. If they were just working on the farm for nothing, they got a paycheck or something. It's not the same as, being part of the ownership structure and seeing what their equity grow over time. I talk about B builds equity while deferring tax. This is that profits interest that I talked about where, we're only paying taxes on the profits. We're not paying tax on the appreciation of the business. So, the business grows twofold. You're getting more of an interest in the business that's more valuable at the end of each year. And the timing can be controlled. That spigot, the person that put the equity on, we can meet each year like, hey, it was 75-50, but I think it should be closer to 65-35. Do you agree? And, making sure all parties agree, that spigot can be turned on and off. Mike, you mentioned earlier about a capital interest versus a profits interest. Now, what we're talking about here is most partnerships that were classically set up, you have an interest in the liquidation of the proceeds of the business. That's a capital interest. The profits interest is you're entitled to the profits and the appreciation of the business. So, upon liquidation, in a profits interest, depends where they're at in that life cycle of that agreement, whether or not they're going to be, coming out at that full, say you have a 75% profits interest. Well, that doesn't mean on day 2 of that, a $1 million business that the person that brought nothing in now has, $750,000 worth of the business in their pocket. That's not the way that works. It works a little bit more like over time, we transfer the business interest and the capital interest in that business by paying tax and the appreciation of the business. So when we transfer the capital, we've been paying tax on it over time. So after 10 years, that person that came in with 0 now might have 65% of the business and a lot more of that capital than when they came in. What I'm talking about here, this is a little tax rules. It's tax-free unless you get tripped up into these 2 things, that the income is predictable. Like this can't be a sure thing. There's got to be risk is really what it's saying. And then the other thing is, hey, if the partner comes in and within 2 years they get rid of it, well, that's kind of avoiding it at the IRS. That's, you're just trying to move quickly through avoiding estate, gift, any of those other kind of taxes by using this interest. Profits interest LLC. So, the ownership over time, you can see this. So they come in at 0 at a 50% profits interest. Over the next 10 years, they could grow their interest up to like, say, 36%. This is a per case thing. It's just for an example. If you want to accelerate that, say that, how about the younger generation pays 75% of the taxes on this profitable venture? Over time, you can see that, their interest in the business, that their equity kind of goes up at a much quicker rate. And a lot of times that we'll have, when we set these things up, we set it up with a vesting schedule over 5 years, 10 years, to kind of, give assurances to the people that came in with all the equity that want this to turn out a certain way, that the people that they're bringing in business, it will turn out that way.
Just a quick couple of comments there. Again, the profits interest only works if the business is highly profitable and growing. And that's where for many farms it doesn't work. And I see the tendency towards the capital interests.
Yep.
But the other thing I want to comment, you just mentioned the word vesting, which I might have mentioned in the first workshop, but just in case, to score the concept of vesting is, and we've used this in capital interest LLCs where we're transferring gifting capital interest over time. Is the vesting is a period of time that people have to stay with the business before they're actually able to take all of that equity that they gain, and that's and you'll see this with a lot of employer-owned companies. That there's all the employees come in and they'll become, after they're there for a year or so, they start to become owners, and they have a vesting period. Yep. And it just means that if they left earlier than the vesting period, they can't take all the equity with them. And particularly if you're gifting equity to people in any way, having a vesting time period is actually can be very useful, so that you can feel confident that you're not going to all of a sudden, for the LLC agreement, have to buy them out in the buy-sell agreement after you just gifted them a bunch of equity. You might be able to take some of that equity with them, depending on how you have the vesting schedule set up, but they probably wouldn't be able to take all of it unless they've been there for 5 years or 10 years or whatever your vesting schedule is.
A good operating agreement, like Will mentioned a little earlier, that's a very valuable thing. It's very important to develop an operating agreement when you first get into business with people. It's I say you need to have it done then, because it's going to be the most important document when you want to get out of business, when nobody's talking to each other. And families can be really brutal about that. But very important document. I could spend a whole time talking about operating agreements, but best to consult a good lawyer and who understands the state law in the state you operate. The next couple of slides we can go through real quick, because they're just how you increase equity and how to decrease equity in any partnership that you're in. You have your beginning equity. You can increase it by capital contributed, the income that you book, the appreciation in the assets. Things that reduce your equity are draws, booking losses, not profitable years, and depreciation. That gets you to the end equity. We like to talk about what can we control. I say you can control all three, because you can alternate things. I talk really quickly here about guaranteed payments in a partnership. They're important because on a younger generation, somebody that has a lot of equity can draw out that equity until it becomes zero, tax-free, which is great. So, the person that's bringing in a lot of the equity into the business, the stuff, they can draw down tax-free without having it really impact them in a taxable way. Somebody that is coming into the partnership that doesn't have that large amount of equity, we set them up with what's called a guaranteed payment. So irrespective of profitability, they need $1,000 a month to live on. That's a guaranteed payment. That is them drawing money out of the business that doesn't hit their capital account, bringing them down to zero. It shows up as self-employment income on their personal tax return. So that negates them taking money out of the business without having basis to do it. The profits interest kind of can do the other two things, kind of keeping an eye on depreciation, appreciation, and being profitable. So I'm just going to blow through that real quick.
Can we just real on the guaranteed payments? Because I think so. I just want to write down a little bit more on. So when we set up the LLC to bring on these other partners, that you can be taking, how you get compensated if you're a member of this is either taking a draw, or you could be taking a guaranteed payment. If you're filing taxes as a partnership, if you're an S corp, you can be an employee. If you can't be an employee in an LLC filing as a partnership.
That's correct.
So that's how you're having to make a choice. And that's where you need to be talking to somebody like Nick to say, what is the best choice? We take a draw, we take a guaranteed payment, or do we take a hybrid, which I see is very, very common. People say we need this to live on for each month. But then at the end of the year, they'll look and say, how profitable were we? Do we each want to take more of a draw, or do we want to be buying some equipment or prepaying expenses to bring down the profit? And that's a discussion that people often have with their tax accountant in December when they've got a pretty good idea about where they're at with things. And I think the other thing about the guaranteed payments that people usually like about it is that it as opposed to your draw is not an expense for the business when you go to income tax, but it is a guaranteed payment is. And if I'm misstating that, Nick, correct me. Otherwise, if you want to elaborate on that at all.
It is because you're carrying as a partner, you're going to capture that income down on your personal return that you're basically self-employed. So it's still an expense of the business, whereas a draw isn't. You're just taking out equity. And that's why they're taxed very differently. Now, you can only take out the equity in the business to the point that you've put in or paid tax on. So it's important to keep track of your capital accounts. You can't just, a lot of times I'll hear somebody say, well, we like partnerships because you can take money out tax-free. Well, that's half the story. You can take out money tax-free if you have the basis to do it. If you don't, you can end up having a tax liability because you've drawn in excess of your basis. And the guarantee payment helps alleviate that kind of issue.
We have
some of the other.
We have 6 minutes, and I do want to make sure that everybody sees that Will has put the evaluation into the chat. Please put the evaluation. Please fill out the evaluation for us. And Nick, if in the next, unless there's any questions on anything we've just talked about, which you can put in the chat or open your mic. If Nick, if there's some you want to wrap up in the next 5 minutes, then we could.
I will forward these slides on to you so you can look them over. You can also reach out to me if you have any questions or Mike. Some of the things to watch out for is, like we mentioned the guarantee payment. I mentioned the family partnership rules. Those are kind of those anti-churning, you can't use these to avoid taxes, bringing in family members. There's some things to watch out for, but any tax person should be able to help you watch that. Another thing is built-in gains, that's really in the tax weeds, so I don't want to spend much time on that. The big things to look out for in this are make sure that you have those big 5 documents kind of in place. Your life insurance, will, a trust, power of attorney, durable power of attorney, and then how are you going to operate the businesses? How do you get in and out? Are you being given the stuff? Are you leaving the stuff behind? Is somebody buying it straight out from you? Or are you using kind of a combination of all? And that's what that LLC really does. This is when the plan backfires in a profits interest is say, if you're not profitable. Well, the profits interest, it's not going to work for you because your ownership will actually go down over time. So it's one thing to watch out for. The guaranteed payment we talked about. So I have these 4 slides, understanding interest. So there's the capital interest, and then you have the profits interest, and you can set up either way. And so they're both very valuable tools in our toolbox to transfer assets using LLCs. That one I talked about real quick. It's just making sure that you check the boxes on there's some risk involved, and you're not just getting in and out of this. I think with that, I have this last slide here on just the different things that we covered. The estate and gift tax, income tax, or watch the cash flow. Mike did a great job talking about long-term care being equal versus equal. The wills, trust, power of attorney, and then the 5 ways that you can kind of transfer assets. And a good plan is going to use all the tools in the toolbox, in my opinion. So thank you for letting me talk to you all today. I look forward to, I always enjoy talking to the Land for Good people. So
Unless there's any last minute questions, I think I just want to thank everybody for coming today, and feel free to follow up follow up with us. And as we've indicated, it's, these things can be pretty complicated, and we're never going to cover everything in 2 hours on this sort of stuff. And so definitely get your team together, find a good accountant to work with, and, and really look at your particular situation from the angle that of what you've got going on and what you want to try to do. And often we'll have things go back and forth where we'll be looking at, this is what we want to do on the business side, family side. The lawyer will have an input, Nick will have input, or the other accountants, and it'll go back and forth until we try to find that right medium that addresses, doesn't eliminate taxes, but mitigates them, while also addressing the legal side of things in a way that everybody feels comfortable and secure. And it's often a lot of back and forth process. It's not always just, we figure it all out. We go to the accountant, they tell us this is what the taxes are due. It doesn't usually work that way. There's often back and forth. So again, thank you for coming. Next week, the last webinar with our farmer panel, and we look forward to having you then. Bye.